Hey there, it's a beautiful day, it's a wonderful time, and this is JLJ's World. Welcome to Forex Trading for Beginners Part 3. I am Joe Lovai, and I'll be taking you through the common terms used in Forex trading. Remember, this is the channel that brings you educational videos from all scopes of life. You only need to subscribe and hit the notification bell so that you can never miss out on any of the videos that I post. I want to give thanks to the returning subscribers. I appreciate you, and please continue watching and sharing these videos. You never know who needs to learn this. And if this is your first time on this channel, take time and check my previous videos, and I'm sure you'll be able to catch up with the rest. And if you've not subscribed, as I leave the disclaimer and the intro part to play, please subscribe. See you in a second. This is JLJ's World. Welcome back, guys. This is Forex Trading for Beginners Part 3. We are going to talk about the common terms used in Forex trading. As a trader, there are several terms that you will commonly be using and seeing. In this tutorial, we are going to explain some of these terms for you to understand them better. In Part 2, I talked about how to begin trading Forex. We learned that for you to begin your journey as a Forex trader, you need to have an account with a Forex broker of your choice. Once you have a trading account, it can either be a real account or a demo account. So, a real account refers to an account where real money is used to trade the market. It is actually the money you deposit in your broker account for the purpose of trading. This money can be withdrawn anytime and as long as you wish. On the other hand, a demo account refers to a trading account that has fake money, as in, that money is not real and cannot be withdrawn. Trading in a demo account allows you to learn and practice in a risk-free simulated environment. In simple terms, a demo account is an account that behaves like a real account, only that the money in a demo account is for practice purposes only. As a Forex trader, you must first analyze the market before you make any decision. Analysis is simply the gathering of sufficient information that will help you decide whether to buy or sell a particular currency pair. There are two types of analysis, that is, technical analysis and fundamental analysis. Technical analysis is the most common type of analysis. It involves analyzing the history of price movement and chart patterns by the use of technical tools such as indicators, Fibonacci, and others. These tools help you to speculate the future direction of the market, and in fact, most traders I know are technical traders. Fundamental analysis is the contrast of technical analysis. It focuses on the fundamental metrics of currencies by using economic news such as non-farm payrolls, unemployment rates, etc. We shall get to know about economic news and how they affect currencies as we continue with this course. Fundamental and technical traders can be categorized into day traders, swing traders, and scalpers. Day traders are traders who buy an asset or currency pair with the intention of selling the same asset on the same day so that they can make profit. Swing traders are the contrast of day traders. Swing trading requires you to hold a trade overnight. Swing traders will typically hold a trade for at least one night and perhaps many nights, weeks, and sometimes months. It simply depends on your patience levels. So, it is important to be patient, guys. Okay, let us look at the scalpers. Scalping is a trading strategy where traders profit from small changes in price of an asset or a currency pair. It relies heavily on technical analysis and it is a very fast-paced activity for traders. It also requires one to be very alert, and with good risk management, one can make a good amount of money through scalping. Yet, listen to this carefully, guys. The opposite of what I've said is true. Oh yes, if you can't manage your risk, your day will end in premium tears. You will lose your account before you notice. For those who have had time to look at the Forex market charts, you will notice that the market moves in an up and down curve. When the curve goes up, the market is said to be bullish. A bullish market refers to a strong market where the overall trend or direction of price is moving higher. If a trader is bullish, they expect the value of an asset to rise. On the other hand, when the market curve moves downward, the market is said to be bearish. So, a bearish market refers to a weak market where the overall trend or direction of price is moving lower. If a trader is bearish, they expect the value or price of the currency to go down. It is on this basis of bullish markets that traders decide whether to buy, in other words, take a long, or sell, in other words, take a short. So, let us explore these two terms, long and short. Long. This is anticipating that the value of a currency pair will rise in price. When traders are long or have taken a long on a trade, it means that the market is bullish and they have bought the currency pair. Their expectation is that the value of the currency pair will continue rising, and as it rises, they will make profit. Traders who are long will profit when the price goes up, and they will lose money when the price goes down. Short. This is anticipating that the value of a currency pair will fall in price. When traders are short, they are selling a currency pair and are expecting the value of the currency pair to go down. In other words, these traders expect the market to be bearish and hence make profit. If the value of the currency pair goes up and they are short, they will make a loss. They only make a profit if the value of the currency pair falls. Buying and selling are kith and kin to ask price and bid price. Ask price is the price at which you execute a buy, and bid price is the price at which you execute a sell. The difference between ask and bid price is called the spread. Brokers actually vary the spread so that they can also make profit. Okay, let us talk a little bit about Forex brokers and spread. Spread is one of the factors that we use when choosing a Forex broker. If you are a scalper, consider using a Forex broker with small spreads since it will be difficult to make good progress with large spreads. Please note, spreads usually increase during volatile economic news. So as a trader, you should be careful during such times as we shall learn later. When you trade and leave your trades to run across midnight, you will be charged a swap. Swaps are simply defined as charges for holding a trade across midnight. Don't worry, they are not large amounts. So, for those who are worried, it's not going to consume your account by being charged swaps. Now, let us look at what is a pip, a lot size, and leverage. A pip is the unit of measurement used to express change in value of a currency pair. Pips are counted on the fourth decimal place of a pair's price, except for Japanese yen pairs, where a pip is counted to the second decimal place. I want you to take note of this, and I'm repeating it. Pips are counted on the fourth decimal place of a pair's price, except for JPY pairs, where a pip is counted to the second decimal place. Let us use Euro USD pair as an example. If the value of Euro USD rises from 1.13456 to 1.13966, the difference in value will be 0.00510. And since pips are counted to the fourth decimal place, the number of pips made from in this case will be 51 pips. As you can see, 0.00510 actually has 5 decimal places. So, for me to get a full number of pips, I will count up to the fourth decimal places and put a decimal after the fourth decimal place. I hope I'm not confusing you. And that is how I got to 51 pips. For the JPY pairs, let us look at the USD JPY. If I sell USD JPY at 110.520 and exit the trade at 107.410, the difference in price movement will be 3.11. And since pips for the JPY pairs are counted to the second decimal place, the number of pips made in this case will be 311 pips. As you can see, 3.11 had 2 decimal places. So, if I put a decimal after those 2 decimal places, I will remain with 311, and that is how I got that number of pips. A lot size refers to the number of currency units you will use to buy or sell a currency pair. In other words, lot size is a fraction of your balance. It actually refers to the part of your balance that you use to buy or sell a currency pair. Lot sizes determine the amount of money you will make or lose. Before you make any trade, there are values in which you must quantify your trade. These values are the ones called lot sizes, and they can be categorized into micro lots, mini lots, and standard lot sizes. Let us look at the various lot sizes. Micro lots range from 0.01 to 0.09. That means that a micro lot can either be 0.01, 0.05, 0.02, 0.08, as long as it is within a range of 0.01 and 0.09. A mini lot ranges from 0.1 to 0.9. That means it can either be 0.1, 0.3, 0.9, 0.7, as long as it is within a range of 0.1 and 0.9. While a standard lot begins from 1 and above. Depending on the broker you use, some people use standard lot sizes of up to 50. Whoa! Okay, I have not reached that level, but hopefully one day I will be there. However, standard lot sizes can either be, you can use a standard lot size of 1, 2, 3, 4, 5, as long as it's a whole number, that is a standard lot. I hope you're understanding me, guys. I really need you to understand these things, because if you don't get the right basics, you'll mess up in the course of your trading. And that is why I'm trying to explain these things even better. Okay. A standard lot of, let's say, 1 is actually equivalent to $100,000. So if a standard lot, if you're using a standard lot of 2, it's actually equivalent to $200,000. And a standard lot of 4 is actually equivalent to $400,000. What about a mini lot? A mini lot of 0.1 is equivalent to $10,000. So if I use a mini lot of 0.5, then it is equivalent to $50,000. And then a micro lot of 0.01 is equivalent to $1,000. As you can see, this is a lot of money, and most retail traders cannot afford such amounts of money. And that is why we need Forex brokers who provide leverage so that we can be able to trade the various lot sizes. Before we look at how much money you can make by trading the various lot sizes, let us seek to understand what is leverage and why an individual with an account of $1,000 can manage to place a trade using a lot size of 0.1. Yet a lot size of 0.1, as we have seen, is equivalent to $10,000. How is this even possible? First of all, let us define leverage. Leverage is the rate that your cash will be multiplied by to give you the buying power or margin. I repeat, leverage is the rate that your cash will be multiplied by to give you the buying power or margin. For example, a leverage of 1 to 500 means that your trading account capacity or margin is multiplied by 500. So, if you deposited $1,000 to your account and the broker gives you a leverage of 1 to 500, it means that your trading capacity is $1,000 times 500, which is the leverage, and that gives you $500,000. With $500,000, you can use mini lots of 0.1, 0.3, 0.5, etc. to trade. Personally, I cannot use mini lots on $1,000 account since my risk management measures do not allow me. Okay, let us look at another example. If you have an account of $500 and you're given a leverage of 1 to 200 by your broker, it means that you have a trading capacity of 500 times 200, which is $100,000. With $100,000, you can now use microlots of 0.01, 0.03, 0.05, etc. And that is the reason why leverage helps us to be able to trade even if we have small accounts like $1,000, $500, $100, and some even trade with accounts of $50. So it is simply leverage that helps them to trade with such an amount of money. And that is the reason why we need Forex brokers. However, please note, over-leveraged accounts are also risky because there's a chance that you can make a lot of money and at the same time you can even lose a lot of money. So that is the reality. So when you're choosing leverage, make sure you're not choosing exaggerated leverage like 1 to 2,000. No, use within a normal range. 1 to 100 or 1 to 500 is actually enough. Now that we have understood the relationship between leverage, account balance, and lot size, let us see how much money you can make by using various lot sizes. The profit or loss made using various lot sizes is calculated using the formula profit or loss equals to lot size times pips times 10. So if we have to use our example of Euro USD where we made 51 pips, if I place a long trade with a micro lot of 0.05 and make 51 pips, my profit will be 0.05 times the number of pips, which is 51 pips times 10. This gives me $5. So if you make 51 pips and you traded with a lot size of 0.05, you will make $5. What if I used a lot size of 0.7 and I make the same 51 pips? My profit or loss will be 0.7 times the number of pips, 51 times 10, and this gives me $357. So what if I used a standard lot of say $2? My profit will be 2 times 51 times 10, and this gives me $1,020. As you can see, the higher the lot size, the more money you make. However, the lot size you can use depends on your trading capital and the amount of leverage offered to you by the broker. I hope you're learning and enjoying this video. If you do, please click the thumbs up button and don't forget to subscribe. One thing you should know is that any trade you make, be it a sell or a buy, it must have three aspects. That is, an entry point, a stop loss, and a take profit. An entry point is the point at which you made a buy or a sell. A stop loss is the point at which you are willing to take a loss. And a take profit is the point at which you are willing to take a profit. The stop loss levels helps you maintain good risk management. Risk management is simply knowing what you are willing to lose in a particular trade so that you do not blow your account. And finally, blowing an account. It simply means losing all your money in the course of trading. Yes, blowing an account simply means losing all your money in the course of trading. But just before you blow an account, you receive what we call a margin call from your broker, telling you that your account has fallen below the minimum requirements. You therefore have a choice to either add more money to your account or close all your trades and save the remaining amount. Or at the worst, you can simply decide to take no action and your account will be blown. Yeah, you can decide that. And that's a choice. So, thank you so much for tuning in today. I hope you've learned something. If you have a question, please leave it in the comment box below. I am your humble boy, Joe Luvai, and this is JLJ's World.